Yes. Hi, everyone. Thanks for joining the call. And Chris, thanks for having me on today. I am just going to go over our product. Let me share my screen here. Let's see. Okay. All right. So now you should see my screen. So yeah, I've been with Allianz for a little over 6 years, in the industry over 15. So and here at Allianz, we have only one life insurance product. And that's what I'm going to share with you today. It is our Allianz Life Accumulator IUL. If you're not familiar with Allianz, we are a very large annuity carrier. We've led the industry, I want to say, like we've been in the top three in the last 20 years, and been the most sales in a lot of them. And so we are very good at indexing, and so that's why we're in that space. It's kind of our bread and butter. We're not in the term space. We're not in the protection really base. So when you're looking at our product, it is going to be more the cash value insurance, looking forward to supplement income. So what I'm going to go over today is just our product overview, kind of what makes our product tick. And then at the end, I'll open it up for any questions you guys have. But again, I thank you for taking your time out of your day to learn a little bit about who we are and about our product. So my agenda is just to go over our product and then some of our allocation options. I really want to touch on number 3 here, our index lock. That is one of our key features that sets our product out than a lot of other IULs, if you guys work that space. And then flexible access to cash value and customize the policy. So if with Indexed Universal Life, these are the 3 buckets. Obviously it has death benefit protection for insurance, and then accumulation, flexible access. When I look at this slide, I do key to look at it is accumulation. Why you get somebody into this product compared to like maybe a whole life or a guaranteed UL is really that accumulation piece. Where most of the clients, I would say, when you're looking at a client that might fit this product, it's going to be somebody who has the discretionary income to overfund a policy, not looking to minimally fund it. I would say, typical, target market is that person who's been in their career for some time and has that, some money to put out a life insurance policy. And sometimes it might be that it could be a person that maybe has maxed out their qualified assets. Maybe they have a bunch of money just sitting in a savings account, not earning much interest. That's where a life insurance policy can really make sense as a non-qualified asset, because you have really that tax-deferred growth, tax-free death benefit, and then in the form of loans, tax-free income as well. So, but the nice thing about it is it does offer the protection, the death benefit. It has the chance for accumulation, and then flexible access in the form of loans, and then also our chronic illness rider, which I'll touch on in a little bit. So if you haven't worked much with indexed universal life products in the past, the great thing about them is that you're not really invested like in a variable product in the market. So downturns in the market isn't going to impact your cash value. At worst, it has a 0% floor. So if the index doesn't perform, the client isn't getting anything interest credited to them, but at least you have that downside protection of that 0% floor. And then with an IUL, because not only does it offer that death benefit, it has that, that your premium money is getting put in their different index options. You watch those index options grow, and then their cash value grows, and then in time you can turn that in the form of loans and income on the back end. So when you look at your index allocation, this is just an example on this slide of, let's say the client starts out the year, it's up 5%, it drops down down to negative, and then it goes up throughout the year. And so wherever it ends at typically is where you're going to get that credit for the year. So if it has a positive return, your client's going to get positive, but if an index shows a negative return, you're just going to get in that floor 0. So that's really something to remember when working with index products. So currently in our lineup of index, if you do work with in the IUL space, you're probably very familiar. Well, any index, S&P 500, pretty much everyone's familiar with that one. So we do have that one, but we do also have 4 other index options. The top 2 are our Bloomberg and PIMCO. Those are going to be our volatility controlled indexes. Our Bloomberg is volatility that exposes a few different equity components. And then the PIMCO has a bond and equity component. When I'm talking about volatility, it really has a tracking mechanism on what the market is doing, and then shifting weight inside of it dependent upon, if the bond market's down, it's going to have higher equities. If equities are down, we might invest a little bit more in bonds. So that's the PIMCO. And then in the Bloomberg, it's managed, and it's more made up of equities, but there is some volatility as far as what controls in it. Now, when we're talking about these indexes, I don't go over them in very much detail, but we do have an index allocation guide that you're going to have all the historical performances. We also can provide links to both Bloomberg and PIMCO, so you can track what it's past performed, what it's been, how it's been weighted, and then with the blended futures, it is a mixture of both 60% equity and 40% bond. And then on the S&P futures, they're very similar to the S&P 500, but with our product, the S&P futures is uncapped, whereas our standard S&P is going to be capped at 12.5%. And then we also do offer a fixed allocation, which is one of the highest in the industry, currently at 5.5%. And so that's a strong thing that you can certainly put money into as well, just to make sure your client gets a positive return. You can, with all these index options, you can allocate up to 100%. You can have a mixture of all of them. We do a lot of times preach diversification with our product. We just think it makes sense to have your toes in a little bit of in a few of them, just in case one index has performed badly, where you have that chance of getting a 0. Maybe another index performs well and you're getting the client some sort of return. And there's a lot of flexibility with index allocations. You can change these on an annual basis. You'll have 30 days after the anniversary date to make any changes. On our statements, it's going to show what the upcoming participation and cap rates are going to be at. Now, the top 4 here are all going to be uncapped. The only cap that we have is on our standard S&P, but otherwise all the other ones are going to be uncapped indices. And what I will do as well, and I'll provide Chris after our call that he can get out to you, is our index allocation guide. Again, that's going to give you more details of our index options. I'll also include our current rate cap sheet that'll show the current rates and all of that. So you have that. But the historicals are good to look at on that guide. We have 3 different crediting methods. So typically, the ones you guys might be used to is annual point to point. That's pretty common in the industry, where you're basically just looking at what the index value is today, comparing it a year later, and that's going to determine what kind of credit the client would get. If it's, like I said, showed in that previous slide, if it's up, then we'll apply that. If it went to 0, they just won't get anything credited for that year. But we do have 2 other crediting methods, our monthly sum and our trigger method. Those are solely going to be tied to our S&P 500 index. And how the monthly sum works is it does have a cap rate of 3.8% currently. And you're actually, instead of looking at the index on an annual, you're looking at it on a monthly basis, and you're taking both the positives and the negatives into account there. And so let's just say that S&P 500 had a continual climb month over month. You would, was over 3.8%. You basically could take 3.8 times 12, which is going to give you an over 40%, 45% return. Now, more than likely, the S&P 500 is going to have a little more volatility, where there's going to be some positive months, some negative months. You basically add all 12 months of those together, and that's going to determine, what percentage is going to get credited to the policy. The other option we have is our trigger method. That is solely tied to the S&P 500. How that trigger works is that our current trigger rate is 8.25%. So again, it tracks the S&P. If that S&P has a positive value from the previous year, then the client gets the trigger rate of 8.25. It could be as low as 0.1% on, as far as what the gain was. As long as it's went up from the previous year, they're getting the trigger no matter what. That trigger will show on each annual statement. That can change, but ever since we've been running this product, it's been around that 8%. We do have bonus options on our product as well. So basically, these are just enhancement kickers on top of whatever the return is. And so currently we have 3 bonus options, the far two, the classic and the bonus. There's no additional charges on those two. The classic is a 1% guaranteed flat rate bonus. It's just going to be added on, basically paid throughout the year, but basically that puts the client's floor at 1%. Even if there's no return on the index, the policy will still gain 1% in that bonus. And then the other two are 15 and 40 are multiplier bonuses. That's just basically taking whatever the return is and adding an additional 15% or 40% on top of it. So simple math would be like if you had a 7% return, you would just take 7 times 1.15. That's just over 8%, 805. So that's basically what the client would get credited. And then that same math with the 40%, you take 7 times 1.4, we'd actually credit 9.8 to the policy instead of 7. Now with that select, as you can see on this screen, there is a 1% annual asset charge. So that basically is any money that's in the select would get that 1% asset charge. Even though you get that internal fee, I guess when we look at our bonus options, I do think that select can be the best option, just because I believe it's around 3.5% if the index has that greater return, then that 40% is going to give you a higher credit compared to the other options that we've had. Why don't because I just see there's like 5 or 6 of you on the call here. I'll stop there. I know we covered just a couple of things on the indexes and bonuses. Do we have any questions on what I've covered so far? And no problem.
I have a question on my end.
Yeah.
So what types of clients would you say are the best fit for this product?
Yeah, so I know I kind of covered that a little bit earlier, but I would say it's really good for juveniles or minors that have, they have such a long period of time where you're putting it can be like a lower premium amount that's going in, but after 30, 40 years, when you run an illustration, by the time, they may need to access it with, you could pay for 20 years or whatever, and then you could see, pretty nice size cash values and income on those. But then also, I would say you're looking for a client that has that insurance need, right? This is insurance, but also maybe I always believe that insurance, like a cash value life insurance, can be good in someone's portfolio as non-qualified money, because let's say your client is in a certain tax bracket and they get to that age where they're taking required minimum distributions. Might make sense for them to take out some money out of the non-qualified, because they're not going to get taxed on any of that, and it could keep them under a lower tax bracket. But yeah, just the tax advantages life insurance brings and makes it attractive to a lot of clients. But then you're also looking at the clients that, again, because we're not, if you have a client that's looking for the most amount of insurance at the lowest premium, that's not going to be our product. It's going to be, because again, our product is more designed to accumulate cash with our index options and some of the other features we have within the product. So it's going to be that client that's looking for, supplemental retirement income, later in life, and using it as the tax advantages life insurance brings.
Oh, and are there any case studies or success stories of agents effectively positioning this product?
Yeah, I do have a brochure. I can send. We do have some things on that as far as how to position it, and the type of client to look at. We do have stuff on that I could send out.
Doesn't seem to be any more questions.
Okay, sounds good. Well, I'll keep on moving along here, and